Hi there. This is going to be our example 2 case study for Learning Plan 2. Same thing, same type of setup. We have all of the information in the Excel spreadsheet. We can see that there was a fence that has been put up in March of 2016 for $5,000. It's a 7-year useful life asset. We're going to take bonus depreciation on that. There was a computer and a printer purchased in May 2016. That is a 5-year asset for $1,500. We're going to take Section 179 on that. And then we have dairy cows that were purchased in August of 2016, 6 of them at $250 each for 5-year assets. So if we start, we want to calculate the depreciation on each of these before we fill out our Form 4562. Our first one is going to be the fence. We know that our bonus depreciation is going to take half or 50% of that amount. So we're going to write off $2,500 right away, and we have $2,500 left to depreciate. We know that these are not mid-quarter conventions, so we don't have to worry about that. So we just are worried about half-year convention. So if we go back to our depreciation tables up here, we are going to scroll way back up to the half-year convention tables. Eventually. Here we go. So 150 declining balance method, half-year convention. And we know that the fence is a 7-year useful life. So we are in our first year, we go to our recovery period, and our depreciation percentage is 10.71%. So we take that remaining $2,500 and times it by, 1071. So times it by 0.1071, and we get an additional depreciation deduction of $267.75. So we know that our total deduction for depreciation for the fence is $2767.80 or $2768. We move on to the computer and the printer. So it's saying that it's a 5-year useful life, but considering we're taking Section 179 on it, that doesn't really matter because we're going to write off that whole $1,500 right away using the Section 179. So we get the total deduction of $1,500 for that asset. So then we move on to the dairy cows, and it's telling us that there were 6 of them purchased for $250 each. So we need to determine the total amount that we are going to depreciate. So we take the 6 times the $250 each, and we have $1,500 to depreciate. We are not taking Section 179, we are not taking bonus depreciation, we are just taking normal depreciation on this. So we see that it is a 5-year useful life. We come back to our half-year convention tables, and our 5-year useful life has a 15% depreciation percentage to use. So we take the $1,500 and times it by 15%, and we get $225 of a depreciation deduction for this year for those cows. So then we move on to filling out our Form 4562. We know that we have taken special depreciation, bonus depreciation, so we can start in the middle there. That's an easy one to do. So our special depreciation was on our fence, and we took $2,500 on that. We can go back up to the Section 179, and we fill this out. So the maximum amount, remember that we can only take up to $500,000 in a year. So we fill in that. Our total cost of Section 179 property that is placed in service is only our computer and printer because that's all we're taking it on. So $1,500 there. The cost before any reduction in limitation, so we don't have to worry about that. We aren't reducing or limiting our deduction at all. So it again is $1,500. Reduction in limitation is 0 because we are not reducing it. and dollar limitation for the year. So we take line 4 minus line 1, and that would give us 498,500. So as you can see, we aren't going to be anywhere near what our limitation could be for this year. So then we move on to line 6. So we put the description of property, so we put computer and printer. Our cost is $1,500, and the elected cost is that whole $1,500. Generally, these are going to be the same amounts because you're going to elect to take the whole cost of the property or of the asset as Section 179. It could be different because you don't necessarily need to take the full cost, but for our purposes, we don't have to worry about that. So then we move down to line 8. Our total elected cost of Section 179 property is $1,500. Our tentative deduction is, again, $1,500. Any carryover of a disallowed deduction is 0. Our business income limitation, we really don't have to worry about that because we aren't going to limit anything like that. So we can move down to line 12 and enter our total Section 179 expense deduction of $1,500. Seems kind of repetitive, but this is just if you are getting up into those bigger amounts where it could possibly be limited. So we have the Section 179 taken care of as well. We then need to move down to our regular depreciation, and we need to account for the rest of things. So we are going to go to our 5-year property. We have our dairy cows that had the $1,500 basis for depreciation after we took 6 of them times the 250. We have a recovery period of 5 years. Our convention this time is half year. Our method is still 150 DB, 150 declining balance, and our depreciation deduction, if we go back, we remember we're taking $225 of a deduction. So 225 there. Then we have to account for the remainder of the fence that we are calculating for normal depreciation. So remember, it's a 7-year asset. Our basis for depreciation is only the remaining $2,500 that we have not taken bonus depreciation on. So $2,500, recovery period of 7 years, convention is half year, method is 150 DB, and the remaining depreciation deduction we have is $267.75. So $268 because we round. That accounts for all of the amounts, but we still need to total everything. So we scroll down to our summary, and in our total, we can see if we go back and add all of these up. So we're going to take the $2,500 from the bonus, plus the regular depreciation on the fence, plus the Section 179, plus the regular depreciation on the cows, and we have a total of $4,493 that we're taking for Section 179. And that is where we fill that out, because that totals and summarizes all of our deductions for the year. So this then is the end of example 2, and we will move on and do one more example for listed property.